Welcome to TDAM Talks. I'm Justin Flowerday. Today we're going to be talking about what's happening in a fairly volatile world, from geopolitics to markets to earnings. And I'm joined today by Vitali Mossounov. Thanks for being here, Vitali.
Great to be on, Justin. There's no shortage of topics to discuss right now.
Perfect. Coming into 2026, the backdrop looked quite supportive. We were coming off 3 years of double-digit returns. We had really supportive fiscal policy coming into the year. We came off 3 straight rate cuts by the Fed in 2025. The prospect of more in 2026. Defense spending rising across the board. Infrastructure spending rising across the board. We had seen an AI CapEx supercycle, which seemed like it had no end in sight. And then Feb 28th happened. How does that change things from your perspective?
Well, you painted a very rosy picture for 2026, and I think a lot of people were buying into that. As you said, 3 straight years of great returns, 24%, 23%, I think 16% in the U.S. in 2025. And earnings growth, kind of the linchpin of everything that people do get excited about, the output of all of these inputs that you mentioned, double digit last year, and again, strong expectations for growth in 2026. So war is a terrible thing, and that's exactly what the markets are dealing with now. It's the great amount of uncertainty, especially when that war is all about a particular linchpin, in this case, of course, commodity supplies that are either going to flow and keep the price of oil within some reasonable rate that's conducive to the economic growth and all the stimulus you mentioned that's coming down the pipeline, or whether it's going to be the complete opposite and make it rather difficult for the economy to succeed despite all the tailwinds that you mentioned. So quite a few moving pieces now, and I think the markets are very much trying to digest at this juncture. There are all these things that we went into the year that were rather positive. A lot of them are still in place, but to what extent does this change things dramatically? And I think that we could talk about that for quite a bit.
I mean, look, the world with oil at 70 is different than the world of oil at 100, but both are probably manageable for the market, manageable for societies and the economy to keep growing. Oil at 150 is a different concept, and that's going to obviously be very, very disruptive, and most likely, if we got there for a sustained period of time, lead to a recession. Mm-hmm. How do we deal with a world with those types of binary oil outcomes?
Yeah, well, we have to look back at history a little bit before tackling maybe the mathematical aspect of it, where today there's a terrible tragedy, a global conflict, and that we've talked about, it's affecting commodity prices. But it's also not the very first time that in our professional careers and just in I'll just call it the post-World War II era of financialization, mm-hmm. that there have been regional conflicts that have had impact on the supply of key commodities and frankly many other things. Yeah. And if we look at those base rates and ask ourselves, well, how did the market respond to them over some reasonable time horizon? And that reasonable time horizon, in my view, is not 5 days, 10 days, or even 1 month, because that is what's dominated by fear, uncertainty, the fog of war, the media headlines. Everyone wants to think the worst. But as you begin to fast forward to being 3, 6, 9, 12 months into a conflict, what might surprise many is that the market is often not showing any meaningful statistical deviation from its normal returns. So it's just important to say before we get into the oil part of it too deep that there is that scenario, of course, that oil could be at 150. And frankly, that scenario is always on the table. There could be some conflict in some part of the world. We just had another war that started 4 years ago that had a very similar narrative about oil, and oil did indeed spike into the 120, 130 range for some period of time. But I would just push back a little bit, if you'll permit me, because the world is remarkably good. People are remarkably good. Companies are at adapting, making deals sometimes, but in any case, at least adjusting supply chains and being resilient. Oil in and of itself, I think you're the one that pointed this out the other day, our dependence on oil is not what it used to be 50, 60 years ago.
Yeah, no, I think the stat I saw was in the mid-70s. I think overall expenses on oil and oil-related products were something like 13% of GDP. And then last year, I think there were 6. So let's call the oil intensity for the economy maybe has been cut in half. The impact on the consumer psyche, the impact on decision-making by businesses might still be allow for it to have an outsized impact.
The price at the pump is...
That's right.
Yeah.
I guess in some ways, though, oil will do what it does, and consumers will respond, and businesses might respond. But at the end of the day, it will still come down to earnings growth for the market, and that'll be the major driver of the market going forward. And if we look at, the market's performance post-COVID, and we think about, we've seen the market double. Broadly speaking, the S&P 500 has doubled since COVID. And what's driven that over that period of time has been 90% earnings growth. EPS for the S&P 500 went from something like 185 per share to 330 per share next year.
Yep.
That's 90%, I think, growth. And so as we think about earnings and what's in place to continue to drive earnings, how does that play out from your perspective?
Maybe I'll make one more comment on oil, since, as you said, the intensity of the economy with respect to oil has declined. It's still there.
Mm-hmm.
And so as we think about what underpins those earnings, there is a lot of transportation. There is a lot of needing to move goods across the ocean by air, individuals moving around, obviously, on their way to work and whatnot. So as a whole, I think the way I pin it down is there's the direct contribution of oil and oil products production to GDP, and there's the indirect impact.
Mm-hmm.
We might land somewhere in the 5 to 10% range overall when we consider the secondary effects.
Mm-hmm.
I would put that in the camp of material, but not overwhelming.
Right.
And when I think of the U.S. economy, that you're speaking to the change over the past few decades, that today, when you combine, again, oil and oil products, does not really rely anymore on imports, as it did to an enormous degree in the 1970s. And again, we're just talking about one geography here, but of course it is by far the world's largest capital markets and still the largest economy. There is a great resilience, I won't call it immunity, but there is a great resilience to this shock. So taking a step back then and looking at the earnings, there isn't something obvious, and again, this is a little bit contrarian maybe, but there isn't something obvious as we look at the earnings forecasts for various sectors. 16% was the number, we'll call it here in Q1, beginning of Q2. That is the expectation for growth in 2026. There isn't something that is obviously happening right now through a transmission mechanism that's going to cut that number from 16, we'll just call it in half to 8, right?
Right.
Are there pressures, and I've quantified the degree that some of those might happen in the system? Absolutely. But for all of those pressures in price, there's also a response. And remember, the response capability of the S&P 500 firms, and we're looking beyond that as well, of course, into the Russell, but generally, companies are not often subject to these exogenous shocks without having the ability to formulate some kind of response, right? And oftentimes, this is where the pricing power comes out, right? And it's all a delicate balancing act, because you can only exercise that to the degree that the consumer can absorb it, so on and so forth. But that health of the earnings stream we're observing to be actually, we expect it to be rather resilient, A. And B, as we look at the breadth of it across different sectors, it might surprise some, but this will be the first year since 2018 when we have positive earnings growth for just about every single sector,
right?
Including now, most likely, energy.
Right. Yeah, I mean, it's funny. We've seen a period where the large super mega cap tech has led the market, and we've started to see a bit of broadening out in the market in the last late half of 2025. And there's lots of hopes that continues. For it to continue, you do need earnings growth from consumer-related sectors, continued earnings growth from industrials, continued earnings growth. We're seeing a bit of a recovery in real estate. It's not a huge sector, but it contributes. When you break that down and you think about, okay, this has changed certain aspects of that story, is there a sector big enough that can really derail the broad earnings growth story for the market?
Mathematically, technology is the one, and I would take, for those following the gig sectors, that's information technology and communication services, right? And we're suddenly well north of a third of the market. The idea there, though, is you really have a lot of companies, a few companies that are so large, but so, I would say, again, resilient, to use that word, to the shocks of the economy. We saw that in 2022 in the big slowdown when there was impact to the revenue growth of Microsoft and Alphabet and Meta and others, but it wasn't nearly what it might be for a more, again, cyclical industrial company.
Right.
I think those I would put in the we'll watch, but generally safe basket.
Yep.
Some of the expectations that are, I won't say elevated, but some optimistic expectations are for the industrial sector for another year of strong growth, very much informed by the enormous CapEx spending of the Mag 7.
Right.
And so if we do, of course, get into a scenario where the CapEx plans of these companies, I pause because it's difficult to envision as they have just released their annual reports and signaled to the market that they will
$700 billion of CapEx this year.
Incredible numbers.
Yeah.
Now, but if that were to begin to even stop growing, as the expectations are for further growth, but let alone shrink, then of course the trickle-down effect from that onto the industrial sector and then the consumer sector as that money is spent, that to me would be magnitudes greater and as a threat than actually oil.
Right. Yeah. I mean, it's interesting. So you mentioned, I think you mentioned 16% earnings growth in Q1. I think the expectation for the full year might be 15%. And if you broke that down between, the revenue growth for the market and then the operating leverage and margin expansion for a lot of these companies, you kind of reflect on where we've been over the last couple decades in terms of margins and how supportive they've been towards earnings growth. And, I think we went into post financial crisis with margins sub 10%. And we've seen them expand by 35, 40%. And now they're at 13.5, 14%. There's a narrative to say, okay, that was driven by globalization, capital-light business models and software, a whole bunch of really, really positive things for margins. You just mentioned CapEx. We're heading into an environment where capital spending is a major theme. Capital-light software companies are being challenged by artificial intelligence. Is there a path forward for margins to continue to expand to 15, 16, 17%, which would be incredibly supportive for earnings growth? Or do you see there being maybe a bit of a headwind given all the capital intensity that's happening?
Let's acknowledge, as you started that point, revenue growth is pretty good in the mid-single digit range. And maybe we'll get to it later, but there's obviously a nominal component with inflation helping that part out. But then indeed, the last 10, 15 years, the markets have done very well, and margin expansion has been a key to that. A lot of that, I would say the vast majority of it has been margin expansion thanks to the technology sector.
Right.
And the mix as the technology sector has become a greater and greater proportion of the overall market.
Right.
In fact, when our team isolates for the non-technology firms and reviews their margin progression the last 15 years, there's been very little progress.
Right.
So it's really been tech, and as you said, the tech that we know so well is the asset-light tech. It is the Microsoft that needs to spend $10 billion a year, not the $100 billion per year.
Right.
Thankfully, these companies are a bit insulated from a margin perspective because all of this spending is amortized into earnings over many years, but it is creating an enormous headwind, not only for the year ahead, but for the next decade. And so the path to margin expansion, I think, is a lot more difficult for the technology sector than it has been in the past, especially when you consider that software companies, which had absolutely no capital spending to amortize, very little operating expenses, they had historically grown faster than the market. Their market caps expanded even further on multiple expansion, and that helped the story of market expansion, multiple expansion overall, margin expansion. So going forward, it's really going to be, Justin, up to the rest of the market, everything non-tech, to run with the baton there.
Which really are the beneficiaries, potentially, the phase 2, 3, 4 beneficiaries of artificial intelligence as they embed all the new developments into their business model and become more and more efficient. You mentioned inflation. This is obviously on top of people's minds, given the run-up in oil and then the trickle-down effects to other commodities and transportation costs. And I just saw USPS, U.S. Postal Service, increased their transportation surcharge or fuel surcharge by 7-8%. Like it's starting to have an impact, a real impact on people. The backdrop for inflation is, we had an inflation problem, and the Fed fought that problem following COVID, and they brought inflation from, 8-9% down now to 2.5%. We're still not back down to that 2% sweet spot, and if anything, starting to trend the other way. How do you see that playing out in the current environment? And are there a couple different scenarios that you look at where you say, yeah, that's a level of inflation the market may not be comfortable with?
Indeed, we never quite won that battle, right? We got into the mid twos, and for a little while, I think it looked like 2 was within reach. And given what has happened, unfortunately, in the last few months, the teams get a lot of good data from more real-time assessments of what's happening with prices, like your USPS anecdote. And 3% is surely more likely today, as we look out 3, 6, 9 months, than 2%. So, is that in and of itself concerning? Well, no. The market is looking forward, and if 3% is where our assessment will land of a temporary state of inflation, then that is neither an enormous shock, as 8 or 9% was, nor, and I use the word temporary with sort of a lack of forecasting ability towards a geopolitical conflict, but if it is 3% for a short duration of time, then of course we know the markets will look through that. Now, numbers higher than that do become concerning, but again, I want to go back to earlier in the conversation when we spoke to the sensitivity of the U.S. economy to oil, what's changed over the last 50 years, and to me, I do lean on the ability of companies, frankly, their learnings out of COVID, how to run supply chain and gain efficiencies and respond to shocks. I think that was a great training ground for everyone.
In many ways, there was a lot of fear that the equity markets would underperform in an environment of 4 or 5% inflation, and they did the exact opposite because companies adjusted and because inflation was able to come back down quite quickly. And so the pricing power that they're able to take and the ability to protect margins was actually quite something.
It was something else.
I guess the issue becomes, what is the central bank response from this? And do we enter into an environment where the central bank needs to shift monetary policy and tighten it into an area where the economy can no longer grow, has a lot of difficulty growing? And I think there's a question around how much patience are they going to have given the duration of this conflict? And look, I don't think there's really any answer to that. It's just something that we're going to have to continue to watch.
Well, let's unpack that a little bit more if we could, because when we look back at 2021, really, the market peaked very, very late in that year. 2022 was a terrible year for returns, down roughly 20%. But that was a bear market that lasted, I think, about 10 months. We bottomed then in the S&P in mid-October, mid to late October of 22. To contextualize what you were asking about, the potential shock and what it might mean for the markets, at a time when we had really the first major inflation shock in 4 decades, and inflation didn't just go to 3, as may be the case today, and didn't go to 4 or 5 or 6, it went to 9, and in many places higher than that. And most people in the financial markets had long forgotten what inflation is or had never seen it. And I would say there was a real argument that we weren't sure if we would be able to defeat it because there was a real it was a runaway train.
Right. It's something we hadn't dealt with before, and everyone just thinks if inflation is really sticky and will stay around.
That, yeah. And all of that happened, and the market fell 20%, and 9 months was the duration of the bear market.
Mm-hmm.
I say that because sometimes when you describe those circumstances, you might think, gosh, the market must have fallen. It was the end of the world, down 60. And so what we're dealing with today, it always feels a lot more scary and potent in the moment because that's when the headlines are, especially when there's geopolitics involved, right? The market starts correcting and people make a lot out of that correction. We're down 3, we're down 4, we're down 5.
Yep.
The world is going to end.
Yeah.
And then you look back every time and nobody can call a bottom of the market. That would be a very foolish thing to do.
That's right.
But as you said, let's just look back to pre-COVID and everything that's happened since, both the pandemic and then effectively we'll call it a recession, though they didn't qualify it that way, but really the bear market and recession of 22. Right. At the end of the day, the market is about 2 times the level, and it's not fluff. It's mostly, as you said in your introduction, it's 90% driven by earnings growth. Mm-hmm. So I harp on that just to contextualize what's happening today.
Yeah, look, let's say we're down at some point in the coming weeks, 10%. Okay,
Sure.
so we're at we've had a 10% sell-off.
Happens all the time.
It
Hard
does.
to believe, but it does.
It really does. And I mean, you think about bull markets and how long they can last. Within every bull market, there are 10% pullbacks. And I think the average pullback of 10% happens, every couple of years, maybe every 18 months. And so the big question becomes, you're down 10%. Maybe we push it to 12. What turns a 10% drawdown into a 20% drawdown, which is typically associated with recession?
Yeah, and let me start by saying that for our, investors on the line, when you're down 10, you always think you're going to go down 20 because down
Right.
10 doesn't feel good.
Yep.
Right? People say, well, this is different from last time. Now, they all felt terrible, right?
Yep.
And when you're down 10, it's usually a terrible idea to sell because the 10 converts into a 20 very rarely. And even if you get it right, good luck getting back in the market on the right time. So let's just put that out there. And when you go into a 20, when you do have those rare instances, then it is very much not, let's say, an exogenous temporary shock, but a structural collapse of something within, call it the system, whether the financial system or the economic system or global of course that would do it. But these are things that I would say, again, looking at the past and at base rates, if one wishes to sit back and try to predict those kind of events, I'd like to find that person that can call.
Sure.
I would hire them immediately.
Yeah.
But that's not. I think statistics and market history don't push you in that direction.
Sure.
Having said that, I think this is always on our mind. What do you pay for an asset, right? We're very careful what we pay for assets. And that can be observed at a headline level. People say, the market's somewhat expensive, and they'd have somewhat of an argument for that. But it's all about context, and it's expensive, yes, but for what level of margins, what level of free cash flow conversion, what level of growth, what's the constitution of the market between sectors and company quality and leverage, and what are we actually buying?
Right.
Because we're not buying the market itself.
Right.
We add a layer of sophistication, complexity, and analysis on that.
Yeah, and I mean, even within the current construct, I mean, if anything, there's going to be very, very different and divergent outcomes for companies in different areas of the world based on energy sensitivity and energy dependence for companies in Europe versus companies in Asia versus companies in North America.
You mentioned other global markets. We talk about the U.S. a lot, right? Yeah. And we invest a lot overseas.
Yeah.
And the interesting thing about Japan and Europe, the other big pockets of developed markets, is, you alluded to this, they have seen a more forceful correction since the war started. That is in large part, there are a couple of reasons. One is they have great energy dependence, rather than independence that the U.S. has, but also they're just more cyclically geared economies, right? A lot of what they do is to serve the United States, if you will, with value-added, complex industrial products and whatnot, but nevertheless they depend on another economy, so they're less resilient, and they don't have that anchor, if you will, of big tech, these more kind of resilient, larger global companies. But you've seen those countries, those indices correct quite a lot, but it's another example of not, I would say, extrapolating things too much. Yes, those markets have corrected 10%, but when you look at Japan, just to pick on that market, for instance, tremendous returns the last couple of years, and really driven by not some multiple expansion, but driven by real structural change in the way that the Tokyo Stock Exchange and really the people in charge over there are pushing companies to return capital to shareholders, be more efficient with their balance sheets. Those are real changes, and what they're unlocking is a great shelf of companies that are selling, producing and selling and inventing, first and foremost, world-class industrial consumer products that are now powering this AI revolution. So as we look across the world, I'll probably stay on the Japan thing, but it does apply to Europe quite a bit. Yes, there can be a sense that, look, Japan, well, they don't produce any energy, right? They've got to bring everything in. So they've shut down a lot of their nuclear. Like, this is the end for Japan. And it can feel like that in the short run, but then you look around and say, hold on, there's a market that's down 10%. That is, but the secular trend from the U.S. via AI that's driving great revenue and earnings growth and margin expansion for their companies, well, that's very much alive. The structural forces that are helping them unlock this value for shareholders, that continues. And Well, Japan just happens to have per capita enormous and the largest strategic petroleum reserves that they're unlocking that can easily get them through several quarters. And so, I just kind of, it's the theme of today, but so many people will look at the headlines and say, well, it's time to panic. And I think what we do very well in this firm is when we actually unpack everything and say, well, in fact, it might be time to do the opposite. And that's a great part of the kind of debate that we have, including on many of our committees and discussions across leaders in the firm.
Terrific.
So, Justin, we've talked a lot about oil, inflation, geopolitics, equity valuations, international markets. We could talk a lot about more, private assets, and the list is endless. And the benefit of TD Asset Management for its investors is we have great competencies, immense professionals in a lot of different areas that think about this all the time. No one person could really grasp all these individually. And I know that we have the WAC, the Wealth Asset Allocation Committee, that is very good at providing guidance to all of us about what the best course of action is. Do you mind talking about that a little bit?
Sure. Yeah. The WAC committee meets monthly, and we set broad directions for asset classes, and then within asset classes, we drill down to some sub-asset classes and provide direction on that level. And WAC met recently, and really there was no change. The position remains as it has been since pretty much the beginning of the year, where we remain overweight equities. Within equities, we have a preference for Canada. We're neutral on the U.S., and international, we're mildly underweight. And really, the Canadian overweight is driven by much of what we discussed today in terms of a world where CapEx is climbing and continuing to remain resilient, where oil prices are elevated, where interest rates might be a touch higher. The Canadian market and the Canadian economy is really well positioned to benefit from a lot of these trends. And the added benefit recently has been, and you saw it towards 2025, is with some of the stability that Mark Carney has brought to the political environment, you're starting to see capital inflows again. And so that's also very supportive of the markets and the economy. So overweight in Canada and equities. In alts, you mentioned, we are also overweight. And within alts, we have a preference for infrastructure and commodities. Infrastructure, this is really the physical assets that are really, really important points in the world and oftentimes are bottlenecks. And so a lot of these infrastructure assets that we own have pricing power. Commodities, we've talked about a whole bunch. And then in fixed income, we are underweight fixed income. We still have a preference for corporate credit. We've seen a little bit of volatility in terms of credit spreads, which were really tight at the beginning of the year. They've widened a little bit. There's actually a lot of the portfolio managers are finding some pretty interesting opportunities given the volatility to pick up credits here and there. And we are underweight cash. And that's the positioning for the Wealth Asset Allocation Committee at the moment.
Fantastic.
So thank you very much, Vitali. I think we covered a lot of ground today. I don't think we solved all the world's problems, but I believe we discussed some of the more important issues that are driving the markets and earnings. And I do look forward to having this discussion in a few months. We'll be doing these updates quarterly, and hopefully at some point we can have you back.
Thanks, Justin. It was a pleasure to be here and look forward to coming back.
Terrific.